Welcome to the Explainer. Today, we're cracking open the Commitment of Traders report. We're going to see where the so-called smart money is placing its bets in a market that, let's be honest, is looking more divided by the day.
Okay, so let's dive right in. The big picture? We're seeing three huge stories unfolding all at once. A major sell-off in gold, a massive bet against stocks, and some really extreme moves in currencies. You know, this isn't just random market noise. It feels like the early tremors of a major shift.
But before we get into the nitty-gritty, you've got to understand who's on the field. There are really two main players in this high-stakes game.
So on one side, you have your speculators. Think of them as the gunslingers, hedge funds, making huge, aggressive bets on where the market's headed. And on the other side, you've got the commercials. Now, these are the corporations with actual skin in the game, the ones using these markets to protect their real-world businesses. They're often called the insiders for a reason. They know their own markets better than anyone.
All right, let's talk about our first major point of tension, gold. What we're seeing here is a classic disconnect between what the price is doing and what traders are actually feeling. At first glance, it looks pretty simple, right? A stampede for the exits. Institutional traders are dumping their long gold positions like crazy. I mean, contracts have just plummeted from a high of almost 300,000 down to 214,000. That's way below the recent average. But, and this is where it gets really interesting, despite that big sell-off, a massive 81% of speculators are still bullish on gold. So yeah, they're trimming their positions, taking a few chips off the table, but the overwhelming majority is still convinced gold is going higher. And that right there is the textbook setup for a bull trap. You have this huge crowded trade that's starting to look a little shaky. So what happens if prices dip a little more and scare that 81%? Well, they could all be forced to sell at once, and that's how you get a flash crash. All of a sudden, the risk of a big drop is way bigger than the chance of a pop higher. Okay, now for what is maybe the most dramatic story in this whole report, a huge, almost historic bet against the U.S. stock market. Just look at this reversal. It's absolutely stunning. Speculators didn't just get a little more bearish on the S&P 500, they went all in. Their net short position more than doubled in a single week. That is a massive bet that stocks are about to take a nosedive. But wait a second, check out this disconnect. While 61% of the speculators are betting the house on a crash, what are the commercials, the actual corporate insiders doing? They are perfectly balanced, 50-50. They're showing absolutely zero signs of panic. And that just perfectly sums up the standoff we're in. The very people who should be freaking out about a downturn, the actual companies that make up the S&P 500, they're not buying extra protection. The insiders aren't scared. And that suggests this whole speculator sell-off might just be a massive overreaction, which could set the stage for a really, really painful short squeeze. Okay, last stop on our tour, the currency markets. This is where we're seeing sentiment just get pushed to some really dangerous extremes. This radar chart is a great way to see which trades have gotten way too crowded. And a crowded trade is just like it sounds. Almost everyone is packed onto the same side of the boat. And you know what happens when a boat gets too heavy on one side, right? It's often a huge warning sign that it's about to tip over. So let's take the Swiss franc versus the US dollar. Get this, a massive 84% of institutional positions are long. When a trade gets that one-sided, it becomes incredibly fragile. Seriously, it wouldn't take much bad news for that trend to reverse hard as everyone scrambles for the exit door at the same time. The Swiss franc is basically sitting on a powder keg. And then, on the complete opposite end of the spectrum, you've got the New Zealand dollar. Only 20% of speculators think it's going up. When you see that kind of extreme universal pessimism, it becomes a prime candidate for a big snapback rally if sentiment starts to shift just a little bit. So let's tie this all together. What does all this mean for the next few weeks? Well, the report basically gives us three critical things to keep an eye on. Here's your strategic watch list. Number one, the S&P 500. With speculators this short, any little piece of good news could trigger a violent rally as they're all forced to buy back their shorts. Number two, gold is facing a huge test of support. Is that massive core of bulls going to hold the line? And number three, keep an eye on the Swiss franc. It's the number one candidate for a reversal, especially if the US dollar starts to look weak. Look, this data isn't a crystal ball, but it's clearly showing deep cracks in what the big players believe. The speculators and the insiders are telling two completely different stories. And that leaves us with a huge question as we watch all this unfold. Are we seeing a smart panic before a real correction? Or is this just one massive, speculative head fake?